I want to just take us back a little bit. A couple of months ago, last year, when we saw Moody's downgrade its outlook on the U.S. and Fitch downgrade the rating on the U.S. credit, they both cited political polarization and brinksmanship in Congress. How should investors view this continued difficulty down in D.C.?
Well, the U.S. is at a historic level of polarization. We can measure it. We know that we're at a level not seen since the early 20th century. And in fact, it's a generational struggle. And sort of the last two baby boomers standing are President Biden and former President Donald Trump. They're going to enter into this climactic struggle. And so it's not a time where polarization is going to fall. In fact, we'll be retesting the high levels that we saw in 2020. And that will make it extraordinarily difficult to avoid a government shutdown and other quandaries this year.
So you say extremely difficult. It sounds like you're expecting there to be a government shutdown at some point.
Well, the issue is that, Speaker Johnson doesn't have a majority now. I mean, he basically has 218 votes. Theoretically, Republicans had 223, but they've lost 5 members. And so it's, like you showed, the yays were 107, the nays were 106. There's just not a margin here for safety. And one member can vote to vacate the speaker's seat if Johnson is too cooperative with the Democrats. And so that means that we can easily have chaos again.
All right. We had actually former House Speaker Paul Ryan on our air yesterday saying, if it's not contentious, you probably aren't doing the job right. I'm paraphrasing. That's basically what he said. I want to talk to you about the national debt. Reached $34 trillion, about a $101,000 obligation for every U.S. citizen. Is this a big deal? It's a contentious issue, but is it genuinely a big deal?
Well, yes, it's a very big deal over the long run, and particularly if interest rates stay high. The higher for longer problem is that then the payment on that debt starts to really pinch the budget, and that will then require Congresses in the future to either raise taxes or to cut spending, or both. And really, it would require both. But interestingly, on the political front, in this context of polarization, what we see are two forms of populism, neither of which will allow those reforms to happen. And so the choice has been to inflate the debt away. And when we look at the Republican side, which had maybe traditionally been the fiscal conservative side, that's not really on offer in the 2024 election. If Republicans win, they'll probably take the Congress as well. They're not likely to be imposing draconian cuts. And they certainly aren't going to be raising taxes. We know that for a fact. On the other hand,
Matt, before we get to the other hand, I want to go to your other area of expertise, geopolitical situations. You have a new story in Barron's right now titled "Middle East Tensions Are Boiling. Don't Bet on Restraint." Bit of an ominous title there. So since the 40s, we haven't seen a recession during an election year. And generally, gridlock is good for the market here in the U.S. But you're seeing a lot of risk, again, when it comes to the Middle East and also the China-U.S. tensions. Give us a sense. How should investors view both of those?
Yeah, well, the main issue here is that the U.S. uncertainty is an invitation for foreign powers to challenge the U.S. and really kind of encroach on U.S. interests. And so there's this negative dynamic, this vicious circle in which Biden's weakness, his low net approval rating, sort of invites the Iranians to try to blackmail him, to threaten the oil supply, to threaten regional instability. And this is causing an escalatory spiral in the region. And we could see this play out in other areas like Russia or with China. And so this year, we're going to see U.S. policy uncertainty, which is typically negative for the stock market, at least in the first half. We're going to see that exacerbated by global actions. And we'll see global policy uncertainty go up, and then that'll feed back to the U.S. And meanwhile, the labor market is actually softening. And that, of course, is negative for the equity market.